Records are being broken on Wall Street, and not just in the stock market, but record-shattering cold. But what does that mean for the U.S. dollar? Joining me now is Paul Christopher, the co-head of real asset strategy at Wells Fargo Investment Institute. Hi, Paul.
Hi, Sue.
So the effects of the strong dollar is being closely watched as corporate earnings roll in. You expect the strong dollar trend to continue, but why do you think the brutal cold winter may give the dollar a chance to pull back?
Well, the cold winter is really going to hit retail sales. It's going to hit housing activity, and it's going to hit those sectors probably more than what the seasonal factors would represent. And so we're going to end up seeing some further softness in U.S. economic reports, and that will help to narrow the divergence between the U.S., which is decent growth, and the rest of the world, which still has low growth. And that difference being closer for this first quarter during the winter will help the dollar consolidate or pull back a little bit.
And talking about some effects overseas, uncertainty in Greece's bailout talks to conflict in Ukraine and Russia, all this is driving downward moves in the market. Stocks, although, are at all-time highs, and some are calling for a correction, if for no other reason that things are just too good to be true. How come you disagree, and why do you think stocks should be favored right now?
Well, we think stocks should be favored for several reasons. First of all, and most importantly, because the economy here in the U.S. continues to gain momentum. We also see a global economy that has a positive trajectory, even though it's a little flatter trajectory than what we see in the U.S. So the problems overseas are not critical problems, we think. And secondly, we have low interest rates, almost zero interest rates short term here in the U.S. and very low inflation. Those are very good combination for U.S. markets. And if you consider as well that U.S. retail investors have not really jumped onto this rally in a big way, it suggests that the sentiment has not gone too far yet. We think this market has further to go upward.
And Wells Fargo Investment Institute has $1.6 trillion in assets under management. Where are you overweight right now, and what sectors are you avoiding?
Yeah, so in terms of the U.S., we prefer those sectors that will take most advantage of an improving economy, low inflation and low interest rates, but with some upside probably to short-term rates in the near term. So we continue to like consumer discretionary sectors, industrials, and information technology. By the same token, on the reverse side of the coin, we would try to avoid or underweight those sectors that might be hurt by rising short-term interest rates and an eventual steepening of the interest rate curve, and those would include consumer staples and utilities.
Paul Christopher is the co-head of real asset strategy at Wells Fargo Investment Institute, and I'm Susanna Lee for The Street.